Hey guys, welcome back to 90 Seconds with Chris. Today's video is a continuation of our previous video on cash flow statements. Please go ahead and watch the first video to bring you up to speed, and also so this video can make sense to you. Link is in the description below. A typical cash flow statement is divided into three parts. The first part is the cash flow from operating activity or cash flow from operations. This is just the amount of money the business brings in based on their core business activities. Like in the example of our bakery, the $2,700 profit brought in during the quarter will be recorded in this section. The next section of our cash flow statement is cash flow from investing activities. This is typically the money spent by the business to expand the business activity. For example, if our bakery decided to acquire a local coffee shop so that we could compete with Starbucks, whatever money we used to acquire this coffee shop will be recorded in this section of the cash flow statement. In our example, we have no intentions of acquiring any coffee shop, so this section will be a $0 amount. Keep in mind that in the real world, this section is typically a negative cash number, as is money leaving the business to acquire something else. But in our bakery example, is zero, as we acquired nothing during that quarter. The last but not least section on the cash flow statement is cash flow from financing activity. In the bakery example, this has a value of zero. But in the real world, say the bakery decided to raise more cash by issuing more stock or borrowing more money in terms of bonds, this amount of money will be recorded here. It's typically a positive number, as it's cash coming into the business, but in the case of debt, it's money you're going to have to pay back later. So the bakery's cash flow statement will look something like this. Cash flow from operating activities will have a value of $2,700, which was the money we made from our sales during our first quarter. Cash from investing activities would have an amount of zero, as we made no acquisitions during this period. And cash flow from financing activities would also have a value of zero, as we decided to raise no money or issue no bonds to bondholders. The sum of these three sections gives us a value called our net change in cash. In this example, it is $2,700, which is just the amount of money that came in from our operating activities. Keep in mind that in the real world, this number is not always equal to just the cash flow from operating activities or our net profits. Also, amount of cash we had before the quarter was $6,500. Once you add the amount of cash we made during the quarter and the amount we had before the quarter, we have $9,200, which is our free cash flow. The investors in this company have claim to this cash and can do whatever they want with it. Thank you guys.